Hi, I'm Cody from Wall Street Breakdown. Welcome back. Today we're going to talk about the fact that you, yes you, are going to die. And what that means for your finances, especially what that means for you planning what to do in the initial steps in taking back control or taking initial control of your finances. So we've been talking in past videos about a few other topics that pertain to getting started, budgeting, the generic overview of what the stock market and the investing world look like. Today, we're going to take a quick look at the fact that you're going to die. We might as well get to spending your money. I seen a purse at the mall I really want. We could spend your money there. Just saying. The fact that you're going to die means that you're going to need life insurance. Now, what kind of life insurance? I know there's a lot of life insurance out there, and you have people that are relying on you. Maybe you're the sole source of income in your house. Whatever it is, you're going to need some type of life insurance to hedge yourself as best you can, especially during your earning years, to make sure that you're keeping up with what your household expects of you. Even in the afterlife, there's expectations. You better be able to live up to them. So what you're going to know is that there's a couple of different types of life insurance out there. Now, you're always going to be sold by the life insurance guy, the whole life insurance, or the universal life insurance, which are basically life insurance that, unless you miss paying your premium or you cancel the policy, they end up lasting, much like in the term whole life, they end up lasting your whole entire life. So there's a few reasons why whole life insurance might be an option, but they're very, very few and far between. If you find yourself sans life insurance and you're, say, 50 years old, you don't have a lot of savings, so people are probably going to end up working well past the years that should be their retirement years. Unfortunately, something like whole life, if there's two of you or more than two of you, you're going to end up probably having to pay that really high premium that you're going to end up getting into at 50 years old or 40 years old if you're really sure that you're not going to be able to make it to retirement properly. But we're talking to a bunch of people, hopefully, that are going to get things together already. They've already got it together. You guys are doing fantastic, I imagine. So we're going to push this forward as if we're doing things the right way. So a life insurance agent, they're going to push you to whole life. They're going to push you to universal life. I'll explain those much deeper in future videos, why they might be relevant to you and the reasons why they might be relevant. But the fact of the matter is, for most people, the only type of insurance, life insurance, that you're going to want is the very cheap, low premium term insurance. That's right. It's not building a cash value. And if you outlive the term, whatever the term is, 10 years, 20 years, term to 65, whatever the term happens to be, you get nothing. You get not a damn cent. For all the money that you put into it, you do not get a dime out of it, but it will protect you during those earnings years. See, the problem with something like whole life insurance is that whole life insurance, because it's going to pay you, it builds a cash value, then it's going to pay a face value no matter when you end up dying. And like I said, as long as you don't miss premiums, yada, 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 it ends up costing you quite a bit in those premiums. That's the issue. $300, $250, depending on the policy, obviously, every month for the duration of your life, unless you pay it up earlier, but it still costs you that amount of money. Now, a whole life insurance policy or something is not a good store of income. Very, very low interest rates. So even though it has a cash value, not an investment of any sort. Do not let anybody ever fool you into believing that whole life insurance is any type of investment that you want. So when you talk about term insurance, on the other hand, and that's what we're talking about, let's say you're 30 years old, you get yourself term to 65. That gives you 35 years. Now, term insurance is going to run until you're 65, unless you miss the premium. Again, no cash value for term insurance, but the term insurance is going to have a very, very low premium, much, much lower, many, 50, 75% easy lower than a whole life policy. And the whole life policy is probably going to have a much smaller face value. You can get term insurance with 8, 10, 12 times your yearly income. Much, much more than you can get with whole life, because they're going to pay it out and you're going to have to pay into it, which ultimately makes your premiums exorbitantly high to get that number paid up by the time that they figure that you might be most likely to die. See, with term insurance, they don't think, well, at least the actuaries at the insurance company have weighed out the odds that they don't think you're going to die in those years. Most people are going to live. Good for you. I hope you have a good, prosperous life in those years. But in those years, you're going to be paying a very small premium. A premium of, let's say, if we're talking whole life at $250, we're going to say $50 for term insurance, right? $50. Just ballpark, you're going to have to shop around and find out, but we'll just use that as an example. You've got an extra $200 between the day today, when you're 30 in this example, and the year that you turn 65, 35 years from now, you have an extra $200 a month you're not paying into whole life insurance, which again is not a good store of money. It's not a place you're going to build any type of prosperity. It is not, whatever an insurance agent tells you, it is not an investment. You've got an extra $200 a month that you can work with for 35 straight years using compounding, and you could be making 15, 20%, depending on the investment vehicle that you're in. Obviously, there's no guarantees in the investment market, but you know, just as an average over time, you are going to do exponentially better as long as you're active with that $200 investing that money. Then, at the age of 65, you should be, and your spouse, financially set to the point where you won't have to worry about having life insurance, because everything will be taken care of, because you will have had that money up front to do something responsible with. That doesn't mean you have an extra $200, you've got term insurance, go out and upgrade your Escalade. That's not what I'm talking about here. I'm talking about taking that $200 and using it to a purpose right now, as opposed to building up a whole life insurance policy, which is relatively fruitless unless you're really expecting to not be able to cover your ends by the time you guys get to retirement age. And I would like to think that if we're here talking about money on a regular basis, that you guys are responsible and you're going to be getting it done long before you get to 65. See, and if you get 8, 10, 12 times your earnings as your term policy face value, and you shit the bed, and that's the end of you. 20 years into the policy, and people aren't ready yet for you to be dead, but you're gone. Sorry. What happens? Well, your wife or husband, who knows who didn't make it here in this scenario, somebody's going to end up getting that money. 10 times your yearly earnings could very easily be invested. And on a year-over-year basis, on average, over the course of 5, 8, 10 years, you would easily be returning on a year-over-year basis roughly the salary of that person who passed away. So you still have that person hedged in if they happen to go inside that time frame of that term insurance. You've got the same plan in place. You get a lump sum of money. You do the same thing you were doing with the extra money you were paying into the premiums of the whole life plan, and you put that money to work to supplement the money that is not coming in now because you ended up losing your loved one to a dinosaur attack. And that's terrible. Nobody likes dinosaur attacks. So you see, term insurance is the answer here, because it gives you the money at the beginning that you're not paying into a premium to do something smart and invest the way you need to invest. But that doesn't mean that insurance is completely off the table. You need to have term insurance before starting any type of investing. This is a must, much like the budgeting that we've covered. This is the absolute bare minimum. You do have to have term insurance, you and your spouse, policies in place. Please take care of your responsibilities out there. You need to be doing this, and the people that rely on you are your responsibility, but make sure you're doing it in the right way to hedge yourself as best you can so that you can invest with your principal more than allowing some insurance company to basically hold it in escrow, because it doesn't make nothing. It makes like 1.5% sitting in a whole life policy. It's terrible. It's a waste of money. Absolute waste of money, unless, like I said, you were at one of those years in your life where there's just no, you're not going to be able to make it, and somebody is going to need to have life insurance policies on each other to make it to the end. And a whole life policy at that point in time might be as expensive as buying term life when you're in your 60s or 70s. And that's pretty negligible conversation. I expect that I'm speaking to a lot of 20, 30, 40-year-olds who try to get their finances in order, and that is the absolute bare minimum of why you should choose term insurance as opposed to whole life variable, term to 100, any other insurance, universal life, any other insurance policies that are out there, despite what an insurance man is going to tell you. I'm Cody from Wall Street Breakdown. Thank you for stopping by once again. Like, subscribe, comment, and have yourself an outstanding day.